the gross profit method, right? We're still dealing with value. This is all inventory. This is purchasing and reselling and dealing with the fair value of different inventory. So the gross profit method is used to estimate the cost of ending inventory. It's used when an estimate is needed due to a casualty loss. All right, so maybe part of our inventory warehouse gets burned down, right? Or what happens? Well, assumptions of this method: beginning inventory plus purchases equals goods to be accounted for. And that makes sense, right? How much should we have? Well, beginning inventory plus purchases. Goods not sold are on hand. Okay, that's, again, pretty straightforward, right? Anything that's not sold is going to just be on hand. And cost of goods available for sale minus sales at cost equals the cost of ending inventory. All of these assumptions are pretty straightforward in cost accounting in terms of inventory, right? In terms of base formulas, nothing too out of the ordinary here. Now, like always, it would not be great explanation if not for seeing examples of it. So Happy Company had the following balances. We had beginning inventory of 100,000, net purchases of 250, net sales of 224, and a historically derived gross profit as a percentage of sales of 30%. Use the gross profit method to estimate the ending inventory. All right, so gross profit rates may be either stated as percentage of sales or percentage of cost, right? Remember back to accounts receivable, we have percentage of sales or percentage of receivables, just different methods, right? It just kind of tells us what we use it for. So using percentage of sales here. Gross profit rates are typically based on historical data. The gross profit method is not normally accepted for financial reporting. We have to calculate it sometimes, and that is where we are, right? So here, what is given, right? What do we have to figure out? So we are trying to figure out the ending inventory, okay? Based on everything. Now, generally, I'd say start with a base formula. Like try a base formula, right? What's our beginning amount plus additions minus subtractions equals ending? Well, in this case, we're kind of doing that, but we need to kind of deal with a few other steps along the way. So our sales, that's given, right? Net sales of 224, that's given. So what's cost of goods sold? Cost of goods sold is the plug because this is a base formula, right? Beginning is cost of goods available for sale. This is going to be your beginning as well as purchases. This is going to be, so that's B and A. Subtraction, this is cost of goods sold. This is what was sold equals E, ending inventory. Base formula all the way for the win, right? You're going to use these and earn lots of points in the exam. So we were given our cost of goods available for sale because we had beginning, we had purchases of 250. So now B is 100, A is 250. Together, that's 350. We did not know cost of goods sold, so that's what we're calculating here. We're trying to calculate cost of goods sold. Well, okay, if we sold 224 and we have we have gross profit, right? Gross profit is essentially the end amount, right? How much did we make from all of this? We plug to find cost of goods sold. So 30% is gross profit. So 30% of 224 is how much money we got after our costs, right? So sales, revenues minus expenses give you profit. We used the percentage of sales to get our profit. We plugged for the cost of goods sold. Cost of goods sold is the subtraction from our inventory balance. We plug it into our S, getting our end result of 193,200. That is our ending inventory balance. This is using gross profit. Now, all these different methods, like nothing absolutely too crazy, right? We're just using these different methods, and we're kind of just basically using the information given to us to figure out what they're asking for. Like none of these are particularly, absolutely beyond tricky in and of themselves.